On January 27, 2026, Deutsche Bank put a number on the table that markets are not supposed to say out loud. $6,000 per ounce for gold in 2026, with a scenario path that stretches even higher. And when a global bank is willing to anchor client conversations around $6,000, the story is no longer about a target. The story is about a breakpoint. Because $6,000 is not just an upside figure on a commodities chart. It is the level where hedging demand can stop behaving like insurance and start behaving like fuel. And if you hold a retirement portfolio built on the old promise, stocks for growth, bonds for stability, this changes everything. What if everything you believed about diversification was built for a world that no longer exists? Here is the mechanism that matters. Not the headline number, but what the number does to positioning, volatility, and correlation. Gold is not rising in a vacuum. It is rising inside a system where protection is being repriced, and where the most crowded portfolios on Earth are forced to hedge the same risk at the same time. This unfolds in 4 stages. Stage 1 is stress accumulation, when debt, deficits, and geopolitical risk build quietly under the surface. Stage 2 is hedge migration, when capital moves from duration to real assets because the bond hedge stops behaving. Stage 3 is convexity activation, when options, volatility targeting, and ETF flows force incremental buying into rising prices. Stage 4 is correlation shock, when stocks and bonds start falling together, and the only liquid hedge left is the one already moving: gold. Throughout the last 60 years, every portfolio regime change followed the same sequence. This isn't prediction. This is pattern recognition from decades of market data, repeated through different eras, different currencies, and different crises. The first case study begins when the rules of money are changed by policy, and portfolios are forced to adapt. On August 15, 1971, the United States suspended the dollar's convertibility into gold. The anchor was removed, and a new era of discretionary currency management began. Over the decade that followed, inflation persisted, trust eroded, and the hedge behavior of assets changed. The market searched for an instrument that could not be printed. In January 1980, gold touched roughly $850 per ounce, after starting the decade near $35. The price action was dramatic, but the portfolio lesson was deeper. In that regime, bonds did not reliably protect purchasing power. When inflation risk is dominant, duration stops functioning as insurance. The cycle's Stage 1 and Stage 2 were visible in plain sight. Stress accumulated, and then hedges migrated. And when the migration begins, it does not move in a straight line. It moves through feedback loops, because the act of hedging becomes a signal, and the signal becomes a trade. The second case study begins inside the era that taught modern investors to worship the 60-40 portfolio. In the early 2000s, the dot-com bust and the policy response rebuilt confidence in financial engineering. Risk was priced as if volatility had been defeated. Then the system met leverage. In 2008, funding markets cracked, and the global economy experienced a violent deleveraging. The U.S. Federal Reserve expanded its balance sheet by trillions over the years that followed. Liquidity returned, but confidence did not fully recover. In September 2011, gold reached about $1,921 per ounce. It was not only an inflation story, it was also a credibility story. When central banks become the buyer of last resort for financial assets, hedging shifts toward assets outside the policy perimeter. The same pattern, same stages, same outcome. The timeline varied, but the sequence never changed. Stress accumulation, hedge migration, convexity activation, correlation shock. In 2008 and its aftermath, the market learned that liquidity can be created instantly, but trust cannot. And once trust becomes the scarce asset, hedging becomes urgent. Urgency is what turns allocation into stampede. The third case study is closer because it reveals the modern machinery that can make a move self-reinforcing. In August 2020, amid the pandemic shock and unprecedented policy support, gold printed a new high near $2,067 per ounce. The rally was not only about fear, it was also about structure, ETF demand, momentum strategies, and options positioning. Then came 2022, when the core promise of diversification broke in public. A classic 60-40 portfolio suffered a steep drawdown, roughly 16.3% for the year. When both assets fall, the investor does not feel balanced. The investor feels exposed. The system responded the way it always responds. It searched for a hedge that does not depend on the bond market behaving. 3 monetary regimes. More than 50 years of market history. Identical 4-stage cycle. The difference now is speed. Because today, hedging does not travel by phone calls and paper tickets. It travels by ETFs, systematic rebalancing, and options flows that can move billions in an hour. Now map the pattern onto the present, using the numbers that exist right now, today, as of January 30th, 2026. On January 27th, 2026, Reuters reported Deutsche Bank's $6,000 call and noted spot gold had reached a record $5,110.50 earlier that week. The metal was already up more than 18% in 2026 after a 64% gain in 2025. That is not a normal commodity move. That is a regime signal. On January 29, 2026, spot gold traded around $5,511.79 and had touched an intraday high near $5,591.61. At those levels, small percentage moves become enormous dollar moves. The ETF plumbing is already visible. SPDR Gold Shares, GLD, shows assets under management near $185.9 billion as of January 28, 2026. BlackRock's iShares Gold Trust, IAU, reports 494.56 tons in trust as of January 28, 2026. That is not sentiment. That is metal custody. Volatility is also speaking. The CBOE Gold ETF Volatility Index printed 39.67 on January 28, 2026, after sitting near the low 30s days earlier. When implied volatility rises with price, it signals demand for convexity, not complacency. This is where $6,000 becomes a breakpoint. At certain levels, the hedging decision stops being discretionary. Consider the mechanics. A pension committee that once held 2% gold might tolerate a slow grind higher. But when gold approaches psychological thresholds with rising volatility, the cost of being unhedged becomes reputational. And reputational risk is what forces institutional action. The World Gold Council's 2025 figures show why the base is already built. Total gold demand exceeded 5,000 tons for the first time, valued around $555 billion. Central bank purchases slowed, but still measured about 863.3 tons in 2025. Meanwhile, gold ETF holdings grew by roughly 801 tons. This is the signature of Stage 2. Hedge migration is no longer a theory, it is measured in tons. The hidden risk is what happens when Stage 3 arrives in a market this large. Convexity activation is where flows can turn linear markets into non-linear outcomes. ETFs do not buy because they have an opinion. They buy because investors add shares, and the structure must be hedged with metal. Options do not buy because they feel safe. They buy because dealers must hedge gamma, and hedging turns into forced demand when price trends persist. Systematic strategies do not buy because they love gold. They buy because volatility, momentum, and correlation inputs tell them to increase exposure. At a certain price level, these mechanisms can synchronize. That synchronization is what makes a move self-reinforcing. And the portfolio shock does not arrive first through gold. It arrives through the relationship between stocks and bonds. For decades, the core hedge for equity risk was duration. When stocks fell, bonds tended to rally, cushioning the blow. But when inflation, debt supply, and term premia dominate, that relationship can flip. Stocks and bonds can decline together. An Oxford Economics Outlook published in October 2025 argued stock-bond correlations could become positive again in 2026, driven by supply shocks, rising term premia, and macro volatility. That is Stage 4. Correlation shock is not an opinion, it is a regime, and regimes change portfolios. This is why $6,000 matters. It is the level where investors stop treating gold as a side allocation and start treating it as the remaining liquid hedge. Now bring in the policy backdrop, because Stage 1 always has a balance sheet. As of January 21, 2026, Federal Reserve total assets were about $6.584 trillion. In modern markets, that number is a pressure gauge. U.S. fiscal math is also visible. U.S. Treasury fiscal data shows a 2025 deficit on the order of $1.78 trillion. When large deficits persist, bond supply rises, refinancing risk rises, and the bond market's ability to hedge equities becomes less reliable. Yields reinforce the picture. The U.S. 10-year Treasury yield was around 4.24% on January 29, 2026, reflecting a market that is still demanding compensation for duration risk. In that environment, the bond portion of a retirement mix is not guaranteed to behave like ballast. It can behave like leverage. If you are 35, 45, or 55, this affects you because the default portfolio most workers own is exposed to a single assumption: that bonds will diversify equities. When that assumption fails, the portfolio does not need a crash to suffer. It only needs correlation. Some will say this time is different because yields are higher than the last decade, and bonds now offer real return. The pattern confirms something harsher. Bonds can offer income and still fail as a hedge when the dominant risk is fiscal credibility and inflation persistence. Others will say gold is already too high and that a $6,000 forecast is simply marketing. But forecasts are not the main event. The main event is the path-dependent behavior of hedging when institutions move in size. When gold rises and volatility rises, the cost of protection rises. Rising protection costs push more investors into owning the hedge outright rather than renting it through options. That shift is subtle, but it matters. Renting protection is a premium. Owning the hedge is a position. And positions are what create flow. Flow is what creates reflexivity. Now examine the second-order effects that most discussions ignore. If gold extends towards $6,000, the relative performance gap between real assets and financial assets becomes politically sensitive. That increases the probability of policy responses, which can raise volatility across markets. If gold extends, miners, royalties, and commodity-linked equities begin to pull capital away from the most crowded equity indices. That reshuffles leadership in equity markets. If gold extends, emerging market reserve behavior becomes more consequential. Central banks that are already diversifying away from the dollar can accelerate without needing to announce it. If gold extends, it pressures the hedging behavior of large asset managers. Risk-parity strategies, volatility control funds, and target date funds all respond to correlation changes. And if equities and bonds move together during that response, the impact concentrates in the exact portfolios most households own. The shock does not have to look like 2008. It can look like controlled losses that compound month after month because diversification stops working. This is where the 4 stages return as a practical map. Stage 1, stress accumulation, is visible in the numbers: large deficits, large balance sheets, geopolitical uncertainty, and shifting reserve incentives. Stage 2, hedge migration, is visible in tons and ETF flows, even when central bank buying slows. Stage 3, convexity activation, is visible when gold volatility surges into the high 30s and 40s while price trends higher. Stage 4, correlation shock, is what arrives when the bond hedge is asked to do 2 jobs at once: protect against recession and protect against inflation, and fails at both. Now look forward 12 to 24 months, not as fortune-telling but as preparation based on how this sequence tends to resolve. The first sign to watch is ETF acceleration. If gold-backed ETFs add metal consistently across multiple weeks, it signals institutional adoption rather than retail enthusiasm. The second sign to watch is volatility that refuses to mean revert. If gold-implied volatility stays elevated even after pullbacks, it signals persistent demand for convexity. The third sign to watch is correlation persistence. If stocks and bonds remain positively correlated through risk-off events, the system is in stage 4, whether investors admit it or not. In that environment, the most dangerous portfolios are the ones that look conservative on paper. A balanced mix can become a concentrated bet on correlation. This isn't fear, this is preparation based on historical precedent. For retirement accounts, it means stress testing assumptions that were built in a different regime. It means measuring drawdowns under positive stock-bond correlation instead of assuming negative correlation. For savings, it means understanding liquidity needs. In correlation shocks, the asset that is easiest to sell is often the one you least want to sell. For anyone near retirement, it means sequence of returns risk becomes more severe. Losses early in retirement cannot be repaired by optimism. And there is a deeper implication. When gold becomes the preferred hedge, it changes the signal content of the gold price itself. The hedge stops being a response to crisis and becomes a referendum on credibility. That is why $6,000 matters, not because it is a round number, but because it is the level that can force institutions to behave in ways that reinforce the move. If Deutsche Bank and Societe Generale are even half right on magnitude, the more important question is not, will gold hit $6,000? The question is, what breaks in the portfolio system before it gets there? The answer is correlation. In the next year, watch for portfolios quietly changing their definition of safety. When safety is redefined, capital moves. Watch for institutions that once relied on bonds to hedge equities beginning to pair duration with real assets. The moment that pairing becomes standard, gold is no longer a trade, it is infrastructure. Watch for pension committees and sovereign funds to discuss gold in the same sentence as strategic allocation, not tactical hedge. That language shift is a flow shift. Here is the thesis in plain terms. $6,000 gold is not the story. The breakpoint is the story. You have a choice. Understand the pattern and position accordingly, or ignore it and hope this time is different. But remember, this time is never different. The pattern is absolute. If this analysis opened your eyes, subscribe now. In my next video, the specific hedging structures that survive correlation shocks will be mapped, one by one, with real-world examples. The hedging breakpoint is approaching. The only question is whether you'll recognize it before it forces your portfolio to.